Welcome back. You're watching Masterclass with Utpal Sheth, and in the third episode of season 3, we would be extensively discussing the whole headline topic is mistakes, but portfolio mistakes. And when I say portfolio mistakes, well, this topic then needs no introduction. So, simple discussion point, but perhaps the most elaborate one. We're only discussing one topic in this episode, portfolio mistakes. What are these mistakes?
So Nikunj, I'm sure over the years, everybody must have come and told you कि क्या लेना चाहिए. They may have come and told you बाजार क्या लगता है. They may have come and asked you अभी निकल जाऊँ क्या. But nobody comes and asks you कि आप बोलते हो ये लेना चाहिए तो उसको मैं क्या परसेंटेज करूँ मेरे पोर्टफोलियो में. And even if somebody did ask you that, your answer would not be the right answer because each person's portfolio construct has to be different. Their risk appetite is different. Their financial circumstances are different. So, portfolio management decisions are unique to each individual and to each institution. One makes portfolio management decisions on the basis of some guiding principles, right? If those guiding principles are not right, for example, then you have a problem. I'm sure you've heard of many people talking about asset allocation decisions, where the weights that you assign to different asset classes, those are very important decisions. But even within the same asset class, the weights that you assign to each of your positions are very important. As Peter Lynch famously said, there is diversification, Diversification, and diversification, which is Diversification. Now, just diversification is not enough to reduce risk, because risk comes from not knowing enough about your stocks. Risk also comes from having a very correlated portfolio. So you may think that you are holding 15, 20, 30 stocks, but if all of those are correlated, then that is not appropriate diversification. And if you hold stocks in which your conviction levels are low, then volatility will shake you off. So the evolution is that diversified portfolio will protect the downside so long as they are uncorrelated, and concentrated portfolios will enhance your upside so long as you build that concentrated portfolio with deep conviction and focus. And I'm not advocating either one of the two here. Each of us has to find our balance there. So certain portfolios are, as they conventionally say, high beta portfolios, right? Whereas certain other portfolios are low beta portfolios. This high beta and low beta is in the context of relative movement to the market movement. However, I would encourage you to think about things in terms of idiosyncratic bets, which means that the underlying factors driving those stocks are driving each stock is different from others. Okay, and when you are a terminal value investor using probabilistic portfolio management, leveraging your differentiated insight and conviction, and build a portfolio of idiosyncratic stocks, then over a period of time, you will move towards a more concentrated portfolio as the number and the weights of gorillas in your portfolio increases, right? So that is an evolution of your portfolio. To make this evolution of portfolio, you have to pass through that journey. That journey is painful. You will make mistakes in that journey, but so long as you learn from those mistakes and rectify those mistakes, hopefully you will evolve fine. What we find in many, there are people who come to me with 120 stocks in their portfolio. With 120 stocks in your portfolio, your returns cannot be different from the index returns. And even if you get index returns from that portfolio, you're good enough. Okay. However, that means that you're investing without conviction, because it's difficult to have conviction or deep conviction in 120 stocks. So even though you may perform with the index, you will perform with the index only for a brief period of time. You will get shaken off somewhere. So to do that over a very long period of time is very difficult. Most people talk about the IRR that their portfolio has given them, but they don't talk about the period for which they have generated those IRRs. If you do a 2x2 matrix of the duration of the IRR and the IRR, the longer you go out in time, the more difficult it is to sustain a very high IRR. But people who do are exceptional.
Why does everybody say that equity will give you return which could be 3 to 4% higher than what the nominal GDP growth is? I mean, why is that like the most talked about number? We have a large SIP investing community now, and that's a number which in a sense comes from every mutual fund. Mutual fund investors are also smart investors, but on an average they have 45 to 50 stocks. Why is that? Why are they not following these simple principles?
See, in response to the first part of your question, it is natural that listed corporates are typically representing the better part of the businesses in any economy, and therefore they will do better than the GDP. Corporate earnings typically grow at a faster pace as compared to GDP. Therefore, equity returns are a little higher, and while the returns are higher, those returns come with some degree of risk, and we call the excess returns of equities over, let's say, long-term government securities as the equity risk premium. Right? So that explains the first part of your question. The second part of your question is, in a mutual fund framework, right? The regulations are different, and you are investing retail money, and therefore you will have a very different context of risk management, right? For proprietary investors or for portfolio managers or AIF managers or long-short funds, the risk framework is different. So as I said, your portfolio composition will be driven by your risk appetite, your financial circumstances, and are unique to each person.
In the graphic which will come up, the word balance is the key. Let's understand that.
Thank you for pointing that out, Nikunj. Balance is an important element in the portfolio. We talked about megatrends, leadership, and intangibles. Now, leadership is always not very obvious to begin with. So you will have clear leaders, near leaders, and emerging leaders, right? You will have a portfolio which is comprising of potential gorillas, but to begin with, it's not very obvious, right? It's only over time that each investment hypothesis gets validated, and you are clearer about who are the gorillas and who are the maybes and who are not the gorillas. And that is how it will evolve. So what will happen is, typically the gorillas in your portfolio will compound at a faster pace than the rest of the portfolio And in the long run, they become a larger and larger part of your portfolio, which is why I believe that for a proprietary investor or an investor who is open to concentration, those gorillas will comprise a meaningful portion, very meaningful portion of your portfolio. But at no point of time will you have a portfolio which is 100% gorillas, meaning certain gorillas. You will always have uncertain gorillas or potential gorillas in your portfolio. So, which is why I said the clear leaders, near leaders, and emerging leaders. For an emerging leader, if an emerging leader becomes 20% of your portfolio, you will not be able to sleep well at night. And even if you are able to sleep well at night out of ignorance,
you'll get up early.
It will be a rude awakening. Therefore, maintaining a balance in your portfolio, driven by probabilistic portfolio management that we talked about earlier, will give you adequate risk management.
Can I say that for terminal value investor, and since we are looking at long term here, 5, 15, 20 years, look outside the comfort of large cap stocks, look outside the comfort of Nifty 50, because magic has already happened there. Those evolved companies, they cannot be the next mega trends.
Nikunj, I would beg to differ there. I feel that there are many potential gorillas in the large caps.
Okay, even today?
Even today.
Okay.
You're finding them at reasonable valuations. In fact, the valuations outside of the large caps are more acute than the large caps today. But as I said, we are not driven by large cap, mid cap, and small cap. We are driven by terminal value investing. So wherever we find terminal value to be very attractive and where we have deep conviction, we will go there. Okay. If valuation is high today for something where we perceive terminal value, we'll start with a smaller position and scale up as the opportunity changes, rather than not participate at all and time the whole position.
You put balance, and there's another category, weights. When we say weights, what are we trying to, perhaps emphasize on?
The weights here is correlated with the probabilistic portfolio management that we talked about earlier, which means if your conviction is high, but the weight in your portfolio is low, then that is a mismatch. As your conviction increases, the weight should keep increasing, irrespective of the market price movement. The weight increasing because of market price movement is one thing. But if your conviction is not high, then you will end up reducing the weight by selling the stock. It's when you have the conviction, that conviction is continuing, then irrespective of the price, you should increase your weight as it is validated more and more and more.
And before we wrap, again, attribution and rectification of mistakes. You're emphasizing a lot on this series on mistakes. It's about course correction, it's about recognizing how to sell, what to buy, and it's also about recognizing them and implementing it and coming back on the track soon.
True. So, first of all, as I said, knowing that this is a mistake itself is not at a point of time. It's a continuous process. To do that process on a continuous basis, you need a high degree of awareness. In that, the realization of mistakes, whether deep introspection and multiple iterations, when you are doing those resulting in opportunity cost or those resulting in actual losses, the rectification of those mistakes in your portfolio is what you do on a periodic basis, I would say. It's not a continuous process because given that your time horizon is very long as a terminal value investor, you don't have to act every day, right? But not acting every day does not mean that you are
Not acting
complacent, or does not mean that you are ignorant or unaware, right? No, it means you remain aware and you act as and when there is a material shift in your assessment.
So before we wrap now, let's look at few mistakes. Buying mistake, a selling mistake. So let's first start with what could be called as a buying mistake.
You know, buying mistakes occur in three forms. We talked about type 1, type 1.5 and type 2. So let me give you one example of a buying mistake for me personally, where I missed a phenomenal company because of a bias. So what was that bias? So in my mind, any lending business which is wholesale funded, it does not lend itself to the process of value creation. And that was my working hypothesis.
And why is that?
Because you will periodically go through times when wholesale funding dries up. And when wholesale funding dries up, you will have a huge negative hit. And that negative hit then destroys your compounding. So this was my working hypothesis. Subsequently, therefore, we missed something in that space, which was an exceptional business model, which was initially wholesale funded. But the management team in that space was so good that they evolved from reducing the risks of being wholesale funded and overcame that risk. And that is something that I missed. When I did realize my mistake, the stock had already run up a lot. But once I built my conviction, irrespective of the run up, I went and invested. But the valuations were something that I was not comfortable with. So I said, let me wait for better valuations. But it kept on going up. So I missed out despite building my conviction. So that was the type 1 error first. But when there was a significant correction in that stock, then I could go in, leverage my conviction based on a differentiated insight, and I bought in the COVID times. Then thereafter it has given me good returns. But first I made the mistake of type 1, and then I made the mistake of type 1.5 of not adding adequately.
But you course corrected when you saw the right time and when there was a panic. So we've discussed type 1. Now
1 and 1.5.
1 and 1.5. Now the other important is judgment error, corporate governance, or risk to the business, which is the type 2. Give us a real life example.
So many years ago, we had done a private equity investment in an engineering company. And that company went for an IPO. And we supported the company in the IPO, but we did not realize adequately that there were challenges in terms of what the corporate governance in that company was, or what the accounting of that company was, and so on. So that was a mistake. We realized the mistake, we exited. But it was a type 2 mistake, and it happens.
Now, I'm going to flip the coin again, which is from buying to selling, which is type 1 mistake in selling. What fits in your real life investing?
So, in selling, let me give you a small example. There was a company in which foreign strategic had given a conditional offer, or was in the process of giving a conditional offer, that they will make the acquisition only if they get 51%. We were significant shareholders there. In accommodating that strategic investment, right, we ended up selling some, though it was not because our conviction had been any lesser. So we sold for a different reason. The opportunity cost of what we sold has been significant. In some way, maybe it also helped create value for the balance, right? So it depends on how you look at it, but nevertheless, from a mathematical perspective, the opportunity cost of what we sold was massive.
Well, this last, before we wrap this edition, which is mistake in selling type 2, pretty much the reverse of buying.
So again, this was a mid-cap company which had already gone up significantly before we bought it. And after we bought it, it went up another 40-50x. But we identified a break in our investment hypothesis.
Which is your conviction got tested?
Actually got compromised.
Okay.
Right. We sold 25% of what we had. But we did not sell the balance 75% at that time.
Even though the conviction got
compromised. Right. And that was because of a business issue and not a management issue. So we sold 25% at very good prices. After that, we got opportunity to sell the balance 75% also, but we did not. And in the process, there was an opportunity cost. We eventually sold the balance of the stock, but at significantly lower prices. So I would say that was a type 1.5 in selling.
Fair point. Okay, so let's summarize this episode, and this is not the grand finale. Another one is coming very soon, the final one of whatever we've summarized in the episodes. Terminal value investing is identifying the long-term journey of wealth creation, which the management and the capability of the management team could be. There are factors which we've discussed, factors like market leadership, intangibles, mega trends. They are crucial. It is important when you're buying, you need to have a long-term view, but it is important to ignore the noise like macro and other factors which are there on the horizon. It is important to understand that when you're betting, you need to bet big. You need to have a significant amount of portfolio commitment, because good investments are rare to find. Best of the best investors have a 14% probability. So when you get a good investment, bet big, have patience, ignore the noise. And if you want to learn more, watch the grand finale next time. Am I missing on anything?
No, you covered it well. Thank you, Nikunj.